Today I'm joined by Greg and Chuck, and I'd love to maybe first have you just briefly introduce yourselves.
Great. I guess I'll start. So I'm Chuck Mounts. I'm the Chief DeFi Officer at S&P Global. And what my team is striving to do is to help our organization both adapt our existing products and services and also create a new generation of products and services that are fit for purpose in decentralized markets. That really kind of stems around the role of data analytics, risk assessments, and ultimately the provision of benchmarks that help stakeholders understand the risk they're taking, provide price transparency, and price kind of formation, and ultimately enhance liquidity in the space.
My name is Greg Genega, and I'm an innovation manager at KPMG focused on Web3, blockchain, digital assets, metaverse, etc. I have 15 years experience in information technology operations as well as IT infrastructure, and I've been in the DeFi and digital asset ecosystem for about 7 years as well. So I'm here to provide value to all things in this area, digital assets, blockchain, etc. to KPMG, and happy to have the conversation here today.
Cool. Yeah, so maybe very briefly on myself. I'm co-founder of Centrifuge. My career also started in Web 2 about 15 years ago, where I spent a ton of time building tech, including more recently working in fintech. Started different startups, and most recently, about 5 years ago, we started Centrifuge with a very broad idea. Like at the time, DeFi didn't exist. Tokenization was a thing, but was tiny and looked very different than it, I think, looks today. But we wanted to figure out how to actually help really any business in the world use on blockchains, ideally open, permissionless blockchains, to transact with each other. And so that's the beginning of Centrifuge. Centrifuge now today is kind of bringing real world assets into DeFi. So we work with the likes of Maker, Aave, and different issuers that kind of borrow from these DeFi protocols. Before we go too deep into the topic, I wanted to start with a question that's maybe a bit of a primer and like an introduction to the topic for anyone that might not be super familiar with it. So I don't know, maybe Greg, you want to take this one actually. Just start very high level, like what is tokenization more broadly and why does it matter?
Sure. So tokenization, I would say, offers a variety of benefits for capital formation and facilitating transaction. You know, there's a one benefit, of course, of allowing transactions of assets to occur 24/7, 365, since they exist on blockchains or similar systems that are always on. But I'd say the real innovation with tokenization comes with the advent of smart contracts, which allows for incredible flexibility and composability in what we can do with these assets. And when I say that, we take any asset you could think of, any security, bond, credit, equity, anything you could think of, and then you basically put it in this tokenized wrapper. And there's this concept in DeFi we frequently refer to as DeFi Legos. And what this refers to is the fact that all these assets and smart contracts can interlock with one another. So this allows you to program really interesting baskets of derivatives. You can even pledge an asset in multiple smart contracts. So imagine being able to do a limit order on the same asset on every exchange available in the market without the need of a third party. You know, this will tighten bid-ask spreads, effectively unify pools of liquidity. And there's a lot of other interesting use cases for it as well. You can distribute yield via rebasing. So I know how we're accustomed to dividends on a quarterly or monthly basis, but imagine we could receive a dividend daily, hourly, or even every minute. And smart contracts allow us to do that with no overhead. So it's an exciting, innovative space for sure, and one prime for disruption of financial markets.
There's one interesting debate internally also with different people that we have is always like when we first built Centrifuge, we started with interest by the second. Mm-hmm. And it makes a lot of sense. It's the only way that it would make sense if you think of it really. Yep. But then actually you start talking to a fund administrator or like a financial organization, like a bank or whatever, and they say, no, that does not work. We have to have 330 interest. We don't do any settlement on the weekends. Et cetera, right? I do agree though, yeah, obviously, and that's why we built it this way, and we're trying to get people to understand this part, but like settling interest by the second is something that's foreign in finance today, although technically maybe have already been feasible for a while, but it does really make sense once you start using crypto. So today we want to talk a bit about innovation and what's happening, especially in kind of like the current climate, whether that's like all the regulatory uncertainty, the technology, the markets, right? Where I think we've clearly gotten to a point, and that's what's coming out of my conversations with a lot of people, where people understand the benefit as you've just described it. They believe the technology is going to come in the long run, but there's definitely a lot of like very big obstacles ahead of us to overcome. So I want to make this conversation a bit around that. But maybe hearing from you two first, and starting with Chuck, what are the most common themes emerging from your conversations across the industry with potential partners, clients that come up currently when speaking about tokenization?
Right. So I would say there's a couple of things. One, you just spoke about, which is the state of policy formation or lack of it, and the implications that it has for the ecosystem broadly, but also for the adoption of traditional players into the ecosystem. So I think that events of the last week are going to prove to be an important catalyst to getting policy formation, at least in the U.S., on a straighter path. So, one of the things we were talking about here internally this morning is that the legal actions that have been taken in the marketplace, most recently this last week, will probably take years to play out. And in the meantime, that provides a pathway for legislative action to come to the fore. So, we're hopeful that that's going to be what happens in the coming period of time, in the next few quarters, that you're going to get policy traction in legislative arena in the U.S. to help frame the ecosystem. And I think that will prove to be a strong catalyst for traditional adoption and the inflow of money into the ecosystem. So that's definitely a topic of conversation that we have with our set of stakeholders. Then the other, when we're talking to traditional clients, it's really interesting to see the focus away from looking at tokens or investing in crypto as an asset class to the tokenization of real world assets and bringing real world assets on chain, and the ability to bring real world income on chain. And that's been a real development, I would say, in the last 6 months or so. So we see a lot of traction around getting to have a better understanding of what a tokenization process looks like, what are the risks that would be inherent with that, what are the opportunity sets for investments or liquidity management or risk management that come along with that. And so I would say that's probably been, outside of the regulatory arena, the most decisive theme that we've seen in our conversations in the last couple of quarters. I don't know, Greg, if you have a similar take on that, or.
Yeah, similarly, we talk to a lot of folks in the financial space, and definitely see that people are in a learning phase, and some are maybe early on with proof of concepts. There's a lot of talk from large financial institutions saying tokenization is the future, and everyone wants to make sure they're at the table for it. Just in mentioning, piggybacking off of what you said in terms of some of the climate right now. When you think about what tokenization is and how it compares with these native digital assets on blockchains, and some of which are maybe coming under fire, and some key players in the market. Tokenization is very, very different. Right? When you think about tokenizing real world assets, these are typical assets, stocks, bonds, funds, et cetera, that have already been going through a registration process with regulators for decades. So in reality, this recent regulatory action doesn't change much in the tokenization space. So we think about tokenization, it just simply provides this new technology wrapper using internet native settlement layers in the form of blockchains, and that provides the rails to interact with assets in new and innovative ways via smart contracts.
So yeah, would largely agree. I guess the big question is, right, like despite obviously the difference between ETH and the tokenized credit fund or security equity product, whatever, right, is clearly there. there's still actually quite a few hurdles on the regulatory side, even for fully regulated products. Like there's no real tokenized public product that exists yet in the US, for example. The SEC has not granted anyone a permission to actually launch a tokenized fund. There's also still quite a bit of infrastructure missing. Do you think that's a place where we will see change that's going to be independent of the current kind of like regulatory challenges and questions for the maybe like the more crypto native assets, or do you think a lot of that will kind of, because it's just so intertwined, one won't be solved without the other?
You want to take the one, Chuck?
Well, I think that from our seat, when we are out speaking in the ecosystem to our traditional clients and kind of a wider stakeholder set, there is tremendous amount of capital, both human and financial capital, that's being invested to build capabilities. So I think that even though you may not, you could view that almost as like the underneath of the iceberg, there's a lot of momentum being built, but it may not be kind of as obvious or clear now, and that the catalyst that can kind of bring that to the surface and unleash it will be kind of more policy clarity. And so policy clarity can come in lots of different forms. It could be clarity on what counts as a security or not. That would be a big one. But it could also be providing some frameworks around things like stablecoins or other parts of the ecosystem. So I don't think it's just a one piece. I think there's a lot of different component parts that could come together that in combination start to unlock the potential of traditional players and kind of bigger asset flows coming into the ecosystem.
I actually think like stablecoins are a good example where like the value add today is already massive and quite easy to grasp, yet we still haven't seen a lot of regulatory clarity. Like for international wire transfers, right? The idea that for an end user to having to go to Western Union and paying like upwards, like north of 5% for transaction fees. Even when I use PayPal, I pay like several percent in fees, right? For something that I'm not sure I actually should generate that much in fees. And I think USDC has done something really impressive here. It has given people a way to send money within seconds, 24/7, in ways that, well, peer-to-peer, and not just that, but then also in automated ways, right? Where you have, for example, streaming salary payments. You could do something like getting paid by the second instead of like one monthly payment. I know, like in the US, you get sometimes weekly, sometimes bi-weekly checks. There's no reason for this to be not by the second in crypto, right? So I think that's a place already where we're arguably not touching securities law, and we're actually kind of completely outside of that conversation. But even there, right, like it's obviously USDC is not legal tender. You can't send USDC to the IRS and pay your taxes with it. It's also questionable what will happen if something really goes wrong. So I agree, like stablecoin legislation is going to be super important. Maybe going away from like just regulation for a little bit, so it doesn't get too boring. Outside of like the lack for regulatory clarity or need for regulatory clarity, is there what are like the things that you would highlight when you're trying to showcase like where the most immediate benefits, value created, innovation kind of will come, that will actually be the kind of like the reasons why banks and regulators will want to actually go through all this work, and the financial services industry as a whole want to go through this work of actually finding a way to deal with it, adopting it from like legal but also operational standpoint? Maybe Greg, what are you seeing with
Sure.
institutions?
Yeah, I think it really comes down to, some of the themes we mentioned already, and that this is a new way for liquidity to come to the market. It's a new way for exchanges, broker dealers, et cetera, globally to interact with each other, kind of on the same standards. When we think about these decentralized technologies, for example, the internet, we all take for granted that this video conference right now, there are these protocols underlying it that are sending packets of data across all kinds of medium, and no one really controls that code and that technology that allows us to do this, very decentralized in nature. So when we think about the concept of decentralization and decentralization with blockchains, and then applying that to the financial ecosystem, that also creates that bed where a liquidity can be shared very, very quickly. Large pools can be unified. If you think about an asset, say of a stock or a piece of a fund or bond or whatever that you might have, and being able to pledge that on every exchange everywhere, or to use it in limit orders and such. There's a lot of innovation that could happen there, and it's that unification, and then using that smart contract code on the back end to link it all together, basically creates a lot of these efficiencies. And we're even seeing some examples of people utilizing blockchains for transacting this way, where it actually reduces some of the overhead. So there's actually financial savings, right? Because when you're replacing trust with truth, and things are very auditable, right? You also have the benefit of removing third-party and counterparty risk, utilizing these centralized technologies, and in some ways that can actually save fees through middlemen and processing and things like that. So I think the efficiency gains, I'm sure everyone's looking to capture, and tokenization, I'm sure, plays a role in that.
I think it's, one of the ways I think about this is the evolution versus the revolution. So the evolution side of this equation, or this story, is really around the efficiencies and efficacy in the market, and the clear ability to either limit or eliminate the role of intermediaries, and reduce the amount of rent charged to facilitate transactions. And that's happening. And you can see that in multiple places around the market, or right now it's still probably more experimental, whether you're looking at digital bond issuance or you're looking at tokenization of funds, as examples of striving to get the efficiency gains and perhaps a wider distribution network. But I think the revolution comes going back to what Greg was mentioning a minute ago, which was the formation of new capital pools and the access to those capital pools from new types of borrowers. And that's going to be the revolution. And I don't think we're ready for that yet. I don't think we're at that stage in the marketplace yet, but I think that's the longer term future. And to me, that's what's really exciting when you look at the potential to unlock a new credit intermediation system on decentralized rails, and the formation of those new capital pools that then get harnessed in companies and by consumers around the world in a new type of way. I think that could be really revolutionary for the global economy, and powering the global economic growth of the future. And kind of going back to your comment a second ago of like getting paid by the second, or kind of real time interest accrual and things, I would liken it to when, think of the first time at the very beginning of the internet, you didn't really imagine that 20 years later, you'd click at your desk on your work from home station and your toothpaste arrives tomorrow morning, or even maybe that night. It's kind of the same thing now. It's hard to imagine that end game where you get the by the minute accrual or the kind of real time pay, but there's no logical reason to think that won't evolve. Like, if there's a consumer demand for it and it can be done in a way that is systemically safe, then the question should be flipped the other way. Why wouldn't that evolve? So I think that's the exciting part of the space, and kind of looking at where we are with the technology developments and the building out of this new ecosystem. And tokenization, in my view, tokenization and bringing these real world assets on chain and expanding those use cases and access to capital is going to be the most exciting space in the ecosystem for the coming years.
So I want to, there's a few things I want to follow up on, but actually also I'm kind of monitoring the chat. If there's any questions that come up, I'll definitely make sure to bring them into the conversation. Matthew asked a thing about the revolution, which is made, like, how does one handle the accredited investor issue? So maybe I want to make this a bit more broadly. Like, do you think, like, we will have a financial system that DeFi will create and tokenization will create a financial system that will be equally used by, let's call them like end users, maybe retail, maybe accredited investors, of course, depending on what products, but as well as like large financial institutions directly, or will there be kind of like different worlds? Right, where will there be one Uniswap that everyone uses, or will there be a Uniswap for a Robinhood and a New York Stock Exchange?
I can start off there, and Greg may have a different view than I do, but I think that's actually one of the core promises. When you look at the investable assets around the world, the institutional tranche has good access and easier access to alternative asset classes and higher yielding but less liquid investment options, whereas the retail market, or and you can break retail into many different component parts, but the retail part of the market has a much more difficult time accessing those types of assets. And I think one of the promises here is that you kind of blend the two, and you can onboard a lot of those retail, whether it's high net worth, ultra high net worth, or mass affluent. You can bring in assets into the ecosystem that have not had easy access before, and that will improve the liquidity, the capital formation and liquidity. So in the end, that's a positive for markets, I think.
I very much agree. I also think, like, probably all of us here on the panel, and probably a lot of our audience as well, is probably of the privileged group of people that have almost unlimited access to a whole bunch of financial products that like probably only 1 billion or less in the world actually have, right? The fact that I can download Robinhood and just with my debit card, like, immediately start buying random stocks is actually not true at all, right? I made the example earlier of Western Union being the reality for most people. Like, we might send money around with Venmo and transfer money to each other for free, like, not a reality in most places. So I do think, like, what you're talking about, like, it is like when we talk about, like, making these products accessible, it's not just to the Americans, right? It's actually to everyone, and to everyone does mean, like, it's a lot harder for a lot of these people to trade these products. But yeah, Greg, what do you think on that topic?
Yeah, I completely agree. I think the democratization of financial services is one of those key value prospects of DeFi in general. But I do foresee that there's going to be hurdles here, because you have different areas of regulation that apply to different fields. And so these, like mentioned in the question in the chat, these accredited investor regulations, that's probably a whole different issue than the technology that we're talking about here. It might need to be addressed in a completely different way. So I think it's going to be tricky, because, and kind of go back to your question, will there be, one Uniswap or multiple Uniswaps? Definitely initially, I think there's going to be, to get people comfortable with that, there's going to be multiple. I actually believe there's already an institutional version of Aave, for example, that's different from the core version of Aave. So until we get things right with things like KYC and KYT controls, I think that some of those rules, in order to get people comfortable with them, both the regulators and the financial institutions, I think we're going to see a lot of experimentation, a lot of different areas, and then the market will assess the results of that and see where they find the most value, and then push to grow the areas that, if there needs to be additional regulation or additional technology or whatever, and start pushing forward in those directions.
Yeah. There's a question by VG on the funding gap. Is that something that you want to comment on? Why do SMEs not have access to a lot of the supply chain finance products that larger companies have? And actually, is there something in tokenization, in kind of a lot of this technology that we're building, that will improve that?
Are you asking?
I maybe there's something that you've worked on, Greg. Have you touched supply chain finance much?
I have not, unfortunately.
So then maybe having had my own experience in supply chain finance in the past, and still it's a big asset class for us that I believe in. Is the interesting thing about supply chain finance is it's often very short-term loans, so it makes it more expensive to originate them, right? Because every new transaction you have to go through the paperwork, your risk assessment, pricing, etc. And so it is actually it's one of the biggest discrepancies, I think, in cost of capital is between SMEs who pay, like, for supply chain finance, like 10, easily 15%, sometimes 20% annualized transaction fees or more interest rates. Whereas like a Google, and that actually, sorry, these numbers are outdated. So that was before the interest rates went up. So at the time so it's probably closer to 20 to 25% now. Whereas like a Google, right, for a supply chain finance transaction would pay something like 50, 70 basis points above LIBOR and whatever it is now, blanking on the name right now. But so, right, like this like 10, 15% gap, right? It comes from the fact, well, of course, there's a very good opinion of how much Google's credit rating is, and there's a very good like doing $1 billion in supply chain financing versus 100,000. There's very different economies of scale for those two transactions. But if you just look at like SME default rates, right, they're not 15 to 20% in the US economy. So like there's a lot of that is actually, some of it is manual work, some of it is just transaction overhead that I do believe will get significantly improved if more of this stuff is actually digital or on chain, right?
I think you are seeing, like, so one of the things that you're I think kind of referencing is there can be disparities between industry sectors and disparities between geographic regions in terms of access to funding. And that's true in general, but it's probably exacerbated if you get into the SME sector.
Yeah.
And I think there are solutions that are being developed now that start to tackle and kind of have a geographic focus, a geographic and industry focus. And there, I think that's just the beginning of the evolution of a broader, more global pool of capital that is accessible by a global pool of borrowers. And that is outside of the banking system and all the constraints that a regulated bank has in terms of managing their exposures, taking into account both the idiosyncratic risks of the company itself, but the macro risks that they perceive or have evaluated in a region or particular country. So I think that the evolution of this sort of ecosystem, of a DeFi or crypto finance ecosystem, will help kind of break down some of those barriers and provide that funding gap for viable companies that can use the funding but have a difficult time going through the existing centralized structures.
Exactly. You know, sometimes we forget that one of the key value prospects of public blockchains and the technology here is that decentralization aspect, where anybody can create these wallets, they can get paid, they can participate in these markets, and they don't need to sign up with a local bank or a local government or anything. They don't have to worry about those things. You know, they have the sovereignty over those assets. So if you're and this really rings true in emerging markets, right? You know, we take for granted in the U.S. we live in a very stable country, but overseas, you know, there are plenty of places where it's not as easy, right? And so the ability for anybody with all they need is access to the internet to enter this financial system and transact in this financial system. That's one of the value prospects that's been there since the very beginning for this technology. And so as it matures and there's more interesting products that become available, like we say, that the liquidity can only grow.
Yeah. So I want to move on the conversation a little bit, and I know, Greg, you talked about my question on whether it will be one or two Uniswaps. So I have a bit of a similar question, but it's about private, public, permission blockchains. Like 2017, when we started, we were the only ones thinking that any enterprise would actually use a public blockchain. Not quite the only ones, but that was like the very, very small minority that really believed that something like that would happen. So I have an analogy, and I want to hear from both of you actually what you think, what the future has in play for us. Personally, I obviously have an opinion on what it should look like, but do you think we will actually see neutral international technology players that are fully permissionless and kind of really maybe are more closely related to like the internet, right? Or look like the internet, really, where it's just a bunch of different users. You have North Korea and Turkey and the US and Iran and Israel all using the same internet. Or is it going to look like there's MasterCard, American Express, and Visa, and a few others that are operating these large settlement networks, but largely control them and kind of like are effectively the gatekeepers, right? What do you think is that, are we going to get to a point where obviously the openness and the efficient market hypothesis is that the largest blockchain, the most successful one, should win or should offer the best product? I think most people believe in that in theory. Like, do you think that is actually going to result in something like a truly open blockchain like the internet is today? Or do you think it's going to be always a struggle for large financial institutions to use something like Ethereum?
This is an excellent question. I really think it's the key question in tokenization. So, you know, there are many options we have when looking to build out the tokenization ecosystem at large. So, like you mentioned, blockchains could be private, public, permissionless, centralized, decentralized. I have no doubts that we'll see experimentation with people tokenizing real-world assets on every type of blockchain. But there'll probably, like you said, only be a few that attract a lion's share of the liquidity. And so when we think about one of the key defining value attributes of blockchains, that's the decentralization, right? That's that global access. By using peer-to-peer networks to reduce risk, by also reducing cost and processing overhead. So, but decentralization is a spectrum, right? And depending how you design your platform, there will be trade-offs when it comes to scalability, security, and user experience. So if you design a system that is overly centralized, you might get excellent throughput, but people might be hesitant to devote large amounts of capital relying too much on a single entity, right? What if the entity that creates this platform goes bankrupt or modifies the rules? So maybe there's too much self-dealing or something like that. That's probably not going to work. However, on the other hand, if you design a system that is overly decentralized, like the Ethereum example you mentioned, you might run into issues where adequate KYC and KYT measures become more challenging, or maybe the throughput could be too slow. So the solutions that I think are going to win in the long run are probably the ones that take that Goldilocks approach. So these are probably the ones that will fare the best, right? I foresee large consortiums of financial institutions forming where they create maybe a private permission platform that still has its governance and block validation process, decentralized enough by these individual entities hosting their own nodes, so that if one of them, you know, goes belly up, the system will still keep running. Well, I think we'll almost definitely see some experimentation on that end. But I also see these layer 2 systems built on public blockchains working well too. For example, Polygon supernets, Avalanche subnets, or even zero knowledge rollups on Ethereum. Those can leverage those open networks. They have battle tested security. They're more open platforms. But if you use those systems, you have a bit more customization that allows for KYC, KYT, privacy preservation. That'll help those ecosystems grow and scale. So it's too soon to say, but I've no doubt we'll see the R&D here applied everywhere, and the story is yet to be written. But I think that the decentralized technologies, like you mentioned, that there'll be a role there for sure.
The one thing I would add to that, and everything you said makes sense to me, that you're going to see kind of a mixed bag here and kind of experimentation across the whole spectrum. But it is interesting to note, like, for instance, in Singapore with the Project Guardian sponsored, where the mass is participating. And one of the requirements for that was that it's on public blockchain. So I think it's quite interesting to see that the evolution of the private versus public blockchain and the innovation that happens on public blockchain. And now you have some important policy bodies kind of leaning that direction and kind of pushing innovation towards that channel. So I think the evolution of the KYC, KYT, AL, AML type of requirements that are necessary for institutional players that can be facilitated through zero knowledge and other proofs and other kind of privacy preserving capabilities, but allow verification, will be really important developments for that evolution in public blockchain utilization and future innovation and the build out of a kind of this new transformational credit intermediation ecosystem.
Yeah, there's a comment by a LinkedIn user, I don't know their name, reminds me that intranets were a big thing around 2000. Nobody talks about those anymore. It's all happening on the worldwide distributed internet. As I mentioned, I'm obviously biased. I do believe that it should be open, and I'm very happy to see, like Chuck, as you mentioned, right, the example of banks pushing for doing stuff on open blockchains. I do think that's where the magic power of like DeFi actually is. Now, of course, it doesn't mean that anyone without any KYC checks, without any kind of like risk management, will be able to interact with any other financial institutions, but that can still happen on an open blockchain. So yeah, we're almost coming up on time, but maybe to come back a bit to kind of like the more immediate time, what's happening in the short term. Obviously, this evolving policy situation is going to take some time to figure out, right? I think there's maybe two things we can. I'd love for you both to touch on. First, where should we focus our energy besides obviously the regulatory clarity and kind of figuring out how to do this stuff in the most compliant and the best ways possible? So what are the things on the technology that we need to fix and figure out? And then also on the policy side, like what do you think are the levers that we have and where we can actually make a difference and kind of showcase maybe what the technology is good for, why it needs to be given a regulatory clarity and also the ability to grow.
So outside of regulation, like one of the examples you mentioned, where we see the most imminent opportunities for innovation, I think a big thing there is user interface and user experience, right? So this technology, it only wins when it's invisible to the end user. We can't have everyone manage their own private keys comprised of strings of 24 words they bury in their backyard. We need to lean in on some of these recent standards, such as smart contract wallets and account abstraction, so that we create social recovery options similar to what we're accustomed to with typical Web2 password recovery mechanisms, for example. So we still need to, have the right interface and experience on the front ends, right, to be able to get widespread adoption here. So that's what I see as an immediate need for us to to work on the technology outside the regulation. In terms of with regulation, what we can do, it's tough to say. I don't have a law degree or anything, so but we are seeing some examples out there of current regulation adapting. There's a recent SEC proposal to modify requirements for qualified custodians and take into account properties of digital assets. I know the comment period recently ended for that, so hopefully something comes out of that provides responsible investor protection while also having somewhat reasonable guidelines for custodians to follow. And in terms of what needs to be created new to help with this, I think it's a little bit of a wait and see game, like you mentioned. It's going to be a couple of years potentially. We have to see how these various lawsuits play out. All the legislation that's been proposed in Congress, even though the one bill as recently as last week. We need to see, what eventually makes it into law and go from there. So the best thing we could do today is do our best at interpreting and abiding by the regulation as it's currently written, and then do what we can to follow forward on the technology and make sure that it's in demand and people want to keep building in this space.
I think I'd kind of maybe take a slightly different tack and kind of, I didn't say this in the beginning, but I come from a TradFi background as well. Spent most of my career on Wall Street and started my career as a bank regulator. So kind of come into this space looking at how markets function. And it strikes me that we're at a really interesting and fortuitous time for the evolution of the ecosystem. And that's taking the combination of idiosyncratic drivers in the marketplace. So that would be things like the technology capabilities and the expansion of the ecosystem and the focus on tokenization. So those are idiosyncratic developments set against a backdrop of macro catalysts. And the macro catalysts are economic headwinds, inflationary pressures, the debt, kind of large debt levels, and that you see particularly in the developed world, but also elsewhere. And those things kind of all come together to provide perhaps a perfect storm of catalysts to drive crypto finance and decentralized finance adoption. And so kind of looking at those two sets of different catalysts, but coming together to drive and to galvanize action, whether it's policy action or investment or kind of market ecosystem players action. I think we're in that period now where over the next years, we'll really start to see that coming together. So from an industry point of view, I think the focus on really identifying the use cases and the problems that the technology and the DeFi ecosystem solves is the most important thing. So looking at yield possibilities, looking at reducing frictions in transactions, and democratizing access to investment vehicles. That's what the industry needs to focus on. And providing, one of the barriers to that is around the KYC, KYT, AML type issues. So developing the technology capabilities that help solve some of those challenges will, I think, prove to be instrumental in laying the pathway or paving the pathway for more adoption and monies flowing into the ecosystem. And then on the policy side, it's really kind of the industry, including all of us here and probably everyone we talk to, undertaking to educate and inform and try to elevate the level of what I would consider almost like crypto finance or digital literacy, so that the real issues can be addressed. And you get the best minds in the ecosystem, both the policy side and the market side, to really opine on with a solid understanding of how to advance the agenda to the benefit of consumers, to the benefit of systemic stability in the financial system. And that it just takes a lot of education and a lot of focus on kind of elevating the knowledge set of the people in the ecosystem. And I think that's probably one of the most important things that we, as participants in this system, can be doing right now.
Great. That was a good, maybe closing remark. We're on time. I guess lots of stuff to do. We went in quite a few directions. I like your focus on UX. Like, we definitely haven't solved that yet. I think it's the one thing that does make me optimistic there is just seeing how much UX in technology in general like improves over time, like everything from the internet to mobile devices, and how much easier they've gotten. So we managed to drive forward there as well in crypto. We definitely have to. I agree with you very much. And then, yeah, I think also education, like the unfortunate stuff that gets pressed is Doge and Ponzi schemes, and unfortunately, with the kind of environment that we're in, like, it does attract not just a lot of people that are looking to use this technology for something good, but it also, there's obviously also a few black sheep, and so that is the more we can do to showcase and highlight the good stuff that's happening, and not just focus on whatever 10,000 x crazy volatile token that in the end will result with a lot of possibly retail and sophisticated users losing a lot of money, right? It's just unfortunately not doing us any good. So yeah, I agree with you here as well, Chuck, on making sure we educate everyone around us. Yeah, so super quickly, if there are any last closing comments, please go ahead. Otherwise, like, thank you, Chuck and Greg, for joining me today, and let's see where we are on this topic soon.
Yeah, my pleasure.
Yeah, same here. Thanks for having us.
All right. Thanks for listening in, and comments and questions were great. Hope to see you around soon, and have a good afternoon.